Sophie Baker, the International News Editor, Pensions and Investments, and Director of Programming for the World Pension Summit. And I'm very pleased today to welcome Nick Stansbury, Head of Climate Solutions at LGIM. Hi, Nick. How are you?
Hi, very well. Good morning.
Good morning. So, Nick, ahead of the World Pension Summit taking place in The Hague, 5th to the 7th of November, we are conducting this expert talk ahead of your session on November the 6th on scenarios and stress testing for the energy transition. So what we wanted to do was get to know you a little bit more, get to know a bit more about your role at LGIM, and then I've got a few questions to ask you, if that's okay.
Brilliant.
Wonderful. So can you tell us a little bit about LGIM and your role there?
Yeah, so LGIM are one of the world's largest asset managers. We're a global asset manager, and I look after a team at LGIM that we call Climate Solutions. And our role within the business is to look at the question of climate change, the energy transition, and to understand from a sort of first principles, evidence-led perspective, what the investment implications of the changes that lie ahead of us as a world are, and how we should respond as investors, both to take steps to protect our clients' capital from some of the risks that climate-related changes and the energy transition are going to create, but also how we position for the opportunities and how we use and leverage our exposure to those opportunities to increase the positive impact that we are having on the speed of the transition itself.
So that leads nicely actually into my first question, which was sort of how important the listed companies that pension funds are investing in when it comes to sort of driving forward global emissions in terms of sort of the negation and that sort of thing. And then also how those companies are doing.
Yeah, great question. So listed companies account for something like 1 in every 2 tons of CO2 emissions that take place globally every year. Mm-hmm. So they're about half of the problem, just considering the first order direct emissions that those companies generate. So that's the answer to the first part of the question. They're about half of the problem when we consider direct emissions alone, and much more than half of the problem when we think about their influence on all of the other parts of their value chain and the emissions that are generated there. And what we should be seeing in terms of the emissions from listed corporates is that if the world was on track to realize a net zero 1.5 degree consistent climate outcome, that those emissions should be going down at somewhere between 6 and 8% every single year. Unfortunately, when we look at the data and we go back over the past decade, what we can see is that in aggregate, despite all of the noises that listed companies have made, despite all of the targets that they've put out, their emissions are essentially almost completely flat. In fact, there's only one time period where emissions from listed corporates went down at the rate that we need them to go down by every single year. And that was from peak to trough during the COVID pandemic. So only in one time period over the past decade have emissions gone down anywhere close to the amount that they need to. Instead, half of the world's CO2 problem is not doing anything at all in aggregate about it.
Wow. So, I mean, this feels like a bit of a silly question, but what's the implication of that?
Yeah, it's not. I don't think it is a silly question at all, because I think we all intuitively can understand that there are huge societal implications, right? Social, societal, personal, ethical types of implications of this problem. But that isn't the dimension that I think investors should be thinking about first of all, because we need to be first of all thinking about the investment implications. Those other implications are clearly extremely important and we can't disregard them. But where we start our analysis is to say, okay, well, what are the financial consequences? And many people think that when we talk about the financial consequences of climate change, of that failure to decarbonize, that we can have tendencies to be hyperbolic about it, to kind of use big sounding numbers out of context, make the problem seem bigger than it actually is. But we don't think that's the case. And we think that the world's failure to decarbonize, in particular these listed companies' failure to decarbonize, is creating 2 separate but interrelated problems for asset owners and long-term investors. The first is that it risks creating a very significant systemic issue for the global economy. And we think the size of that systemic risk is somewhere between 10 and 15 percentage points of global economic output by the halfway point in the century. So we can see an enormous systemic issue of an order of magnitude greater than that of the financial crisis. So the systemic issue we think is really big, and we think we've got lots and lots of reasons to believe that we're more likely to be underestimating the size of that risk rather than to be overestimating it. So the systemic issue really, really big, and we think very little confidence that risk is being well priced into markets today. So that's the first issue, a big systemic risk, much bigger, I think, than many people initially like to think that it is, and an issue that isn't discounted, we think, into securities prices very well, if at all, today, although it is hard to be really, really confident about that conclusion. The second issue is then what happens about the listed companies themselves and how well they are allocating capital. Because we know if lots and lots of companies that we're invested in are misallocating capital in terms of the way they're managing their own businesses and the way they are investing shareholder funds into those businesses, that also creates an issue for us as investors. And again, here, we've been doing our maths, looking at the sums, and come to the conclusion that the value of that misallocation of capital, that failure to decarbonize at a company by company level, is going to end up costing listed companies something like $1/3 trillion in the 2030s, a year. So we can see these two issues, a really, really big systemic risk for the world, again, something between 10, maybe as much as 15 percentage points of global economic output at risk, and a very, very significant misallocation of capital going on at listed companies, somewhere of the order of $200, $300 billion, maybe a little bit more every year in the 2030s. And we think these are the two issues that investors need to be focused on. And these are the two issues that I'll be focused on when I've got the privilege of coming out and addressing the summit in just a few weeks' time.
Excellent. We're looking forward to it. So there's lots of things that investors can be doing, should be doing, and we look forward to learning more about those opportunities as well as the risks, because as you said at the beginning, it is about opportunities too, right?
Yeah. Brilliant. Exactly. Thanks, Sophie. Really enjoyed talking with you
Nick,
today.
thank you so much. Look forward to seeing you in a few weeks.
All right. Bye-bye.